If you're not doing top-down analysis or you don't know how to do top-down analysis, you're simply killing your profitability as a day trader. Top-down analysis is essential for framing high probability trades, and it's essential for being able to read price action better. If you can read price action better, that means you can take better setups and more profitable trades. That's why in this video, I'm going to be sharing with you my top-down analysis approach that I use for day trading using smart money concepts. This is the same approach that's allowed me to make multiple six figures in payouts with prop firms, and it allows me to capture high probability trades. I'm going to show you the best high time frame chart to use for day trading. I'm going to show you exactly how I break that high time frame chart down, what I'm looking for, what to look for, and how I take that information, bring it all the way down to a lower time frame 5-minute chart, and execute based on those high time frame ideas. I'm going to be showing you exactly what I look for on the lower time frame. I'm also going to go over some trade examples based on these high time frame ideas and setups, so you can get a better understanding of what it looks like on the lower time frame. So if that sounds good, be sure to stick around and watch this video all the way through to the end. Alright, so I like to start my top down analysis approach on the daily chart. And the reason why the daily chart is my high time frame chart of choice and why I recommend it to everyone, well, there are many reasons which I'm going to get into, but one of the main reasons is that the daily chart produces frequent enough fluctuation that we can capitalize and capture for our day trading opportunities. And the fluctuation is just perfect enough that we can use the volatility and the understanding of the next likely draw to be able to frame our trade ideas around. Because think about trying to day trade but you're doing your high time frame analysis on a weekly chart. It'll be almost impossible because you're waiting a whole week for one candle to print, whereas on the daily chart it's printing every day, so you're able to get a better gauge on price, and it just makes analysis that much easier. And it's not too low of a time frame that regular price action fluctuation is going to throw you off. So that is why I say the daily chart is one of the best. Another important reason why I recommend the daily chart is that the daily chart solves one of the most important problems that ICT traders have, which is daily bias. A lot of ICT traders struggle with, okay, how do I figure out the daily bias? How do I know what my daily bias is going to be? Well, by virtue of you just being able to do your analysis on the daily chart, it solves that problem. Because if you think about it, right? For example, let's say we was anticipating price to go higher and retest this 50% of this bearish order block, right? I'm just saying, this is an example. I'm not saying that's what's going to happen, but let's say we anticipated that price is going to reach up into that, and that is going to be our draw for retest to see how price is going to behave, right? So with that anticipation in mind, all we're saying was that we're anticipating that price is going to print a few candles in order to reach that objective, right? And by virtue of you doing that, if you're correct about your analysis, what you've just done is just predicted 2 days worth of trading, because you got to remember, each candle here represents a day. So when it comes to your daily bias now, because you know what price is most likely to do on the daily chart, that daily candle is a whole day's worth of trading. So that is going to be your daily bias you're going to be anticipating. And it's just a matter of just then going down to the lower time frame and then looking for signs that price is in support of that idea. So if we're anticipating that price is going to be bullishly as it draws in to retest this 50% of this bearish order block, all we're saying that is on the lower time frame, we want to see if price is going to confirm that it wants to be bullish, and we're going to look for bullish signatures in price that support that this is going to be a bullish close day. And what does a bullish signature in price look like on a lower time frame? Well, a bullish signature in price looks like price opens, right, for example, trades lower like this and then closes higher. And all we're doing is that we're anticipating that at the right time of day, we want to see price show the opposing move, because we're anticipating that price is going to be closing higher. We want to see price open at key times of the day. That could be the London session, the New York session, the AM session, right? And we want to see a degree of manipulation in the opposing direction of where we're anticipating price to go. And that manipulation into a hourly fair value gap, a 4 hourly fair value gap, an old low, a previous day's low, a previous 3 days low, a previous session or previous 3 days low. As long as you see that manipulation on the lower time frame in the opposing direction at the right time of day, and then we just wait for the confirmation that price is now ready to start distributing bullishly, and that confirmation would be price trades lower, manipulates, and then breaks structure to the upside. That's a confirmation that price is going to be delivering on the buy side. And we anticipate that because price has just shown manipulation, so the next phase is going to be distribution. So which side is going to be distributing? Well, if we're anticipating for a price to behave bullishly and it trades lower at the right time of day into an opposing PDRA and then breaks structure to the upside, that is price telling you in real time that it's most likely going to be delivering on the buy side. And that's all we're doing. We're just using the high time frame to be able to anticipate, okay, what's price drawing to, and then we just take that and look for lower time frame signals that price is in support of this idea. So the high time frame becomes the framework of our trade, and then we're just following through with that by using our logic around time and price. So if you're not using the daily chart, guys, I highly recommend you start using the daily chart. I know you might be thinking, okay, but how do I know what price is reaching for? How do I know that price is going to be reaching for this? How do I go about that? Well, I know that can sound overwhelming and confusing, but I'm going to share with you a few ideas that I personally use that allow me to be able to predict with high probability what price is most next likely to do. Before I share with you some of my favorite ways of anticipating what is price most likely to do next, you have to remember this foundational understanding is that price is only ever doing two things, right? It's either looking for inefficiencies or seeking liquidity. Those are the only two functions of price that it mainly does. So just by virtue of you knowing this, it gives you a narrowed down framework of what you should be looking for. So if price is near an inefficiency on a high time frame, right, there's a high likely chance it's going to be draw into it. If price is near an old low or an old high on the high time frame, there's a chance that price is going to draw into it because price seeks liquidity and inefficiencies. So just by you having that basic understanding, you're able to know what to look for. My favorite way, and one of the most consistent ways I've been able to find direction and be able to know what price is drawing to, is this, and write this down. If price is near an old high or an old low and there is no opposing PDRA, there's a high likely chance that price is going to draw into that liquidity. Now, what do I mean? For example's sake, let's say price was trading near this old daily low here. So we're trading here and the low is here, right? And remember what I said, if price is trading near an old low or an old high and there's no opposing PDRA, there's a high likely chance that price is going to draw into that liquidity. Well, where's the opposing PDRA here? It would have been this bullish order block, right? That would have been a last key point of support for price to be able to turn around from, and it will be 50% of this bullish order block. So if we had a daily close below 50% of this bullish order block, that would mean that this bullish order block is no longer valid. So that area of support is no longer valid. So if that goes, there is no opposing PDRA that's in the way of price getting to this low now. So I like to look for these opportunities where there is no opposing PDRA and price is near key points of liquidity, because then it's just easy to then frame a trade, because now we're just then going to anticipate that price is going to draw into that, and the distance from where price is currently to the distance of that low, that's going to be the space in which we frame our bearish bias. So I'm going to just be anticipating that there's going to be down close candles forming as price draws for here. So it could take 3 days off of trading for price to get here, and I'm just going to be anticipating that those 3 days of trading is going to be bearish. And they don't all have to be bearish, but I just have to look for signs that price is going to deliver bearishly on the lower time frame. I'm not trying to predict bias for the next 5 weeks, 4 weeks, the next month. No, I'm just using high probability pockets in price where there's a high likely chance that price is going to draw into a certain area. And it doesn't mean I'm going to get it right all the time using this approach, but I do get it right most of the time, and that's what's important. It's just about being able to frame trade ideas around logical approaches to price action using smart money concepts. Another thing you guys should always be considering, right, when it comes to be able to understand what is price drawing to, always be asking yourself these questions in price action. What is price doing right now? Where did it come from? What did it do in the area that it came from? And what is price near? Is it near an old high, an old low? Is it near a fair value gap? And by virtue of you going through these questions, you're able to frame ideas around price action. I'll give an example of something that a recently code one in my free Telegram, right? If you're not in it, join the free Telegram, link in the description below. For example, I code this move here in my free Telegram that price was going to reach into these highs, and I did that by simply understanding, okay, where's price coming from? I saw that price had taken this low here, and I saw price show the willingness to create a bullish order block after taking this key low, and that happened by price having a daily close above this candles open, right? That created the bullish order block. Once I saw that, that was an indicator that, okay, price might be bullisher, because, okay, where did it come from? It come from a point of liquidity, created a swing low, so then that's a signature of a change of direction. And then what happened? Price continues to trade higher, and then we had this immediate rebalance of price here, right? Price rebalanced into this fair value gap, and then what happened? Well, if price was going to be bearish, right, it should have continued going low, but no, it didn't. It rebalanced here and had a bullish close. Once I saw that, I said, okay, there's a high likely chance that price is going to reach into these highs, because where did price come from? Price came from a point of low. What did it do? Immediately rebalanced into an order block after taking a key low. What is it near? It's near old highs, and then I'm just then anticipating the next few days of trading to be bullish. So it's not about having to know the bias forever. It's just about knowing what price is most likely reaching for, and then just using those small pockets and the distance between where price currently is to the draw of what you're anticipating price to reach for. That's where you anticipate your bullish bias or your bearish bias. Another one of my favorite ways of anticipating what price is drawing towards is just using new week opening gaps and new day opening gaps. It's one of the easiest ways to be able to frame a bias, to be able to know what price is most likely to do on the lower time frame. Let's say, for example, we had price open, and when price opened on a new week, we had this massive expansion higher, and then in this massive expansion we had price create a gap. And this happens a lot. If you trade NQ, you know new opening gaps form all the time. All I'm doing, guys, is once I see this, my eye is immediately gonna go to this gap, and I'm gonna wait for price to show me that it wants to start delivering on the sell side, and then I'm gonna anticipate price to draw into that gap. So the gap is gonna be my draw. So for example, we saw price gap higher, we have a new week opening gap, and then let's say in the London session, we saw price start to deliver on the sell side and broke structure lower. Once I see a break of structure lower towards the gap during the right time of day, I'm going to anticipate that price is going to draw into that gap, because time and place are meeting. Once I see that market structure confirmation, that's a confirmation that price is most likely going to be delivering on the sell side. So what's the draw? What's it reaching for? Well, there's a gap below price, so that's going to be our draw for price, and I'm just going to frame a trade around this idea. So whenever you see new day opening gaps and new week opening gaps, and there's enough distance from where price currently is to that gap, anticipate that price is going to be reaching into those gaps, because remember, price seeks inefficiencies or liquidity, and a gap is a high probability inefficiency in price. So I'm just looking for these opportunities where it's easy for me to see price is going to reach into one of these key points, and then I'm just framing my trades around these ideas. And I just go on the lower time frame, and then I'm looking for time and price to meet, and then I'm just waiting to see an opposing move, and then waiting to see price break structure towards the intended direction I'm anticipating price to go into, and then I'm just getting in line with that. And that is my top down approach. I'm starting on the daily chart, and then I'm just working my way down to a lower time frame just to be able to sit in on those trades. And my lower time frame approach is pretty simple. Let's get into my lower time frame approach to see what I'm actually looking for in the lower time frame. I'm actually going to go into some trade examples showing you what I'm looking for and how I execute on these ideas. All right, guys, so on the lower time frame, guys, all I'm simply doing is just getting in line with the high time frame. So I'm already coming into this understanding that, okay, I know what price is reaching for. For example, we were bullish, right? Let's say we're bullish, right? A high time frame anticipation on the daily chart, that price is going to have a bullish daily close. So all I'm doing is I'm just coming to the lower time frame, and I'm just looking for the opposing move. And the opposing move here would be a move lower, because obviously I'm anticipating price to close higher, right? So I'm going to anticipate price to go lower before it goes higher. That's going to be the manipulation aspect of that move. So I'm looking for that move to happen at the right time of day. Now, that manipulation leg, I'm looking for it to trade into a key point of interest. That could be a 1 hour fair value gap, 4 hour fair value gap, a daily fair value gap. Or if it doesn't trade into that, I'm looking for it to trade into previous day's low, previous session lows, or previous 3 days lows. These are the points of interest I'm looking for this opposing move to trade into during the right time of day. So once I see price trade into one of these key points of interest, and the easiest way to frame this is that when you're day trading, right, before you go into your trading sessions, just mark out your 1 hour fair value gaps, your 4 hour fair value gaps, your daily fair value gaps, and mark out your previous day's lows, your previous session lows, and your previous 3 days lows. Have them on the chart, so once you actually start seeing price move at the right time of day, it's easy to know what's most likely reaching for. And you don't need to know which one is gonna work, because that's where the confirmation comes in. So once price trades into one of these key points of interest, all I'm simply doing is just waiting for price to show me a confirmation in the form of a market structure that price is actually now ready to start delivering on the buy side. So essentially we have that move lower, right, like this, trades into a key point of interest, and then from that key point of interest we want to see a break in market structure away from that key point of interest. So once price trades into that key point of interest here, when I see price starts to move higher, break market structure, and then that's going to be the confirmation that price has just gone from manipulation and most likely stepping into distribution. So now once I see this, that's confirmed to me that one of these key point of interest has actually supported price. So that's the confirmation that price is actually going to deliver bullishly, and that's it. And I just simply wait for a retracement just below 50%. It could be that, and then from that I just get in line with price. And then this is where your continuation models work. This is when the order block starts to work, the fair value gaps start to work. I know I'm dropping gems right now, but after the price has gone from manipulation to distribution, prices should now be in bullish order flow. So now all bullish PDRAs on the lower time frame should show a support of price, and then you just get in line with price as price draws higher. And then what do you target? Well, if you're bullish and you're anticipating price to close higher, you're going to be targeting previous day's highs, previous session highs, and previous 3 days highs. So those are going to be your targets as price progresses higher, and that's it. So now let's go into some trade examples. All right, so in this example, we're going to anticipate that we had a bullish bias. So as you can see, at that 9:30 open, what happens? Price trades into the current daily low, right? Price takes the current daily low. So price trades into that, takes the low, and then from the low shows a willingness to trade high and break market structure, confirming that price is now ready to distribute. So at 9:30 time, we saw price trade into the opposing PDRA, which was the current daily low, which would have been the London session low, right? Just post London session low. And then from that, we saw price break structure and then retrade into a fair value gap. And that fair value gap is below 50% of the range. So anything below 50% of the range, I'm going to be getting in line with the market, because I know price has just gone from manipulation, and the market structure is what confirms price going from manipulation into distribution. So now price should be able to deliver on the bullish side. So as you can see, price then started to move higher and break structure again. So even if you miss this entry here, because you understand that price is now delivering bullishly, now order flow is bullish, this breaker structure is just a continuation. So you wait for the breaker structure again, price retrades into another what? Fair value gap right here, and then you can get in line with price because order flow is bullish. And then obviously you have your targets, which would be like your session highs, and then you have like the Asia high up here, which is delineated by this red mark here. So as you can see, if price is bullish and we've seen price go from manipulation to distribution, bullish order flow is now stepping in and price starts to support this idea, and then we're just in line with price. And then as you can see, this is a beautiful bullish delivery. All right, let's get into another example. And a bonus tip, something that you guys should always be looking for, is the relationship between NQ and ES actually. So as price went in and actually took this low, if you go in ES, you can actually see that price actually failed to go below this low that NQ did. So if you already have an understanding that price is going to be bullish and you see ES fail while NQ goes lower, that's an indicator of smart money technique, and that's where smart money technique starts to work. So that's actually showing you that, okay, this is just a run on liquidity. This is just a liquidity sweep. So just something to always pay attention to. If you have a bullish idea or a bearish idea, you always want to look for the relationship between ES and NQ. And if one's showing SMT, then that is just another additional support for your idea. All right, so in this example now, we're going to anticipate that price was going to deliver bullishly on the high time frame. So we had anticipating that price is going to be bullish for the day. So again, we have price at the right time of day at that 9:30 mark. We have price trade into an hourly fair value gap, shows a willingness to move away from there, breaking structure here with displacement towards the bullish intended direction. So once we see that and break a structure, that means that price is now ready to start distributing on the buy side. Price retrades the range that it used to break the structure, and then after we get that 50% retrade, we're then able to enter in on the trade. Our stop loss is always going to be at the low. Once I see this breaker structure, I'm looking where the fair value gaps, which are below 50% of the range, are. Those are the fair value gaps I'm going to be looking for, and that's it for this up. So you see, I'm just looking for simple components on the lower time frame that just confirm the idea of what I did have on the higher time frame. And it's the market structure, seeing price go from manipulation stepping into distribution by virtue of that confirmation on the lower time frame at the right time of day, because it's time and price. That's what builds the high probability anticipation of certain things, and that's why I put my confidence and trust in. All right, in this example, we have a London session. So during the London session, price is trading into an hourly fair value gap. So it's trading within an hourly fair value gap. It's quite flat, and this is a good example because price is not always going to be perfect, but as you can see, let's say we have a bearish bias for the day, right? This shaded area highlights the hourly bearish fair value gap. Price is trading into it within the London session at a time where we anticipate price to show this level of trading into an opposing array. It's trading within it, but it's kind of consolidating during the start of the London session. And then finally, still during the London session, we see price actually show willingness to break structure to the downside here. So it might have been sideways here like this, but then once we see that willingness to break structure to the downside, that's how indicate that we can now start participating in price, because the move to the downside with this displacement here highlights intention. This is why it's important to see displacement within your market structure break. So when you see displacement within the market structure break, that's a very high probability market structure, because displacement highlights intention, right? And all displacement is fair value gaps that are forming when price is breaking structure. So if you see that, that just highlights that price in a hurry to go somewhere, and that signifies the strength of the market structure. So once we see that displacement lower, we're already anticipating that price should be delivering on the sell side. We wait for that breaker structure, which is that low. It's happening inside of an hourly bearish fair value gap, right? And then obviously 50% of that range, like this. Take 50% of the range, and then that's well above 50%. Our stop loss would have been at the high here, so stop loss would never been traded. As you can see, the price still did go sideways, and then eventually it gave up the ghost during the New York session, and then started to sell off. But as you can see, it's respecting the sell side structure, and that's what's most important. So it would have been killing you to wait for price to finally move, but then eventually it moved. All right, in this example here, we're going to anticipate that we had a bearish bias. As you can see, we have relative equal highs here. This is Asia session high. As you can see, going to the London session, price is already above this high, right? But cool, it's going to the London session already above this high. We're anticipating bearish price action, but we don't have no confirmation that price is ready to turn around. So remember, we're waiting for the confirmation. So price could have easily just continued to go higher, but that's why I say it's important to wait for confirmation. And during the right time of day, during the London session, we have that confirmation and that displacement lower, that price is actually ready to turn around. So price is already above key liquidity, a key reference points that we'll be looking for price to be in on the lower time frame. But then we're just waiting to see the confirmation that price actually respected that key point of interest. So we have that break of structure here during a key time of day. We're anticipating price to actually confirm and actually go into its distribution. So we're anticipating bearishness. So we have that price above a key liquidity point, displaces lower, breaking structure to the downside. So as you can see, price trades into this fair value gap here, which is above 50% of this range from this high to this low. That broke this market structure to the downside, and then would have been entered here. A stop loss at the high that was most recent before the break of the structure, and then would have been a beautiful trade targeting Asia lows. And then as you can see, price retrades into it, break structure again here, and then retrades into it again, fair value gap, continuing the sell side distribution, because price is now bearish, so order flow is going to be bearish. So this retrade here is going to be another opportunity to actually get in short, targeting liquidity. My approach is very simple, guys. It's just simply taking a high time frame bias and then going to the lower time frame, looking for accumulation, manipulation, distribution on the lower time frame, and then I'm using that to be able to frame how price should deliver. And once I see price confirm that is going to deliver bearishly on the lower time frame based on accumulation, manipulation, distribution, then I just use that to get in line with price. If you want a more in-depth video about accumulation, manipulation, distribution, I'm going to link a video that I made, complete video talking about accumulation, manipulation, distribution here. Go watch that video. It's going to go over how understanding AMD is important to be able to frame day trading opportunities. But yeah, guys, that's my high time frame approach. I hope you guys found value in this video. If you did, let me know in the comments below what you found valuable. Let me know what other videos I should make. Like, comment, subscribe, and I'll see you guys in the next video.